Well, good afternoon. A warm welcome to everybody. Or for those of you who hail from the UK, a very early morning to you. Uh, Thank you all. I know it's a Friday. Thank you all for joining us today for this webinar, which is jointly organized by the Singapore College of Insurance, SCI, and the Institute Risk Management of the UK. My name is Perry. I'm head of technical training department at SCI, and today's webinar is titled People, Culture, and Public Value, Insurance Risk Management Reimagined. Next slide, please. Thank you. Today's speaker, we are very honored to have the chairman of the IRM. His name is Stephen Sidebottom. His profile is shown here. Nevertheless, I'll just give a brief summary. Stephen has been chair of the Institute of Risk Management since 2021. He's a non-executive director and extensive coach with various organizations. As you can see, he was previously chair of Can Savers, a community bank. He was also more recently the COO of the Global Energy Alliance for People and Planet, global head for business HR for Standard Chartered Bank, and head of HR for Nomura International. Stephen has extensive experience in this field, having lived and worked in Africa, Asia, and the Middle East. Next slide, please. Thank you. All right, so this is the synopsis of today's webinar. All right, so it's talking about people, culture, and leadership, how it shapes insurance risk outcomes. Next slide, please. Thank you. And of course, before we start, you may be interested in some other courses that SCI is running. We have a risk management and insurance for renewable energy projects coming up in a few days' time. People's risk, of course, work injury compensation insurance is very related to human resource and people's risk. And of course, we have a course on health insurance. So if you're interested in these courses, please let us know. And the links for registration will be dropped in this chat box in this webinar. Next slide, please. Thank you. All right, thank you very much. Without much further ado, I shall now hand it over to our speaker for today, Stephen Sidebottom. Hello, Stephen. You can share screen, and I'll leave it to you now. Thank you so much. Yeah.
Hi, Perry. How are you? I think the slides are being delivered by Darian, yes?
Yes, Darren will share the slides, yes.
Okay, great. Thank you. Okay, Darren, if we can go to the first slide, that'd be great. Okay, and move on, please. Next slide, please. Just a little bit about the Institute of Risk Management. If you joined early, you would have seen the videos about both the IRM and the Singapore College of Insurance. IRM is the leading professional body for enterprise risk management, and we celebrated our 40th anniversary. So we operate globally with particular centres in obviously the UK as our home base, but also in Africa, the Middle East, and we're just setting up a formal entity in Malaysia as the centre for our Asian operations. So if we move on to the next slide and we can get on with the meat of the conversation. Okay, so when the public thinks of insurance, my question is, what emotions do you want to come to mind? Do you want people to think of reassurance or suspicion? And I'm going to make 4 propositions and explore these a little bit more in the conversation that we have today. The first is that insurance is society's promise to itself. That's to say, it's not just a commercial product. The second is that the true currency of the industry is trust, rather than, for example, things like financial stability. That's a requirement too, but the trust is this throughput in the entire system. I also want to explore risk management as a human system, and my hypothesis is that it is fundamentally a human system, and understanding the human dynamics of it is necessary when you're thinking about risk management in its entirety. And then my fourth proposition that I'll explore is that people and culture shape every single outcome. Next slide, please. So Perry has already talked about what we're going to focus on. The desired outcomes for this session is some greater understanding of how people and culture shape risk, an ability to start to link leadership behavior to external aspects such as public trust. We'll talk a bit about how the conduct reforms in the global banking sector, particularly looking at the UK example, have created behavioral accountability, and what would need to be true to apply those lessons to strengthen trust and accountability in insurance. Next slide, please. Okay, so let's start with a poll. Just find out where people are at the moment, what you're coming into this conversation thinking. So here's the question: which factor in your mind most shapes public trust in the insurance industry today? And the options are how fairly claims are handled, how transparently products are explained, how responsibly people behave within firms, and how quickly insurers respond in a crisis. All are important, but which do you think is most important in shaping public trust? And if you'd like to vote now, I guess we'll leave a couple of minutes for people to vote. And then when you're ready, Darren, if you want to show us the results, that would be great. Okay, interesting. So nearly half of you think that how fairly claims are handled is the factor which most shapes public trust. Then how quickly insurers respond in a crisis, then how transparently products are explained. And only a very small number of you think about that the responsible behavior of people within the firm is the biggest factor in shaping public trust. Really interesting. What you'll notice about all of those, of course, is that they all have significant behavioral and human people questions. So let's explore all of those a little bit and start by talking about trust. Darren, next slide. Thank you very much indeed. So insurance is one of the few industries that literally exists to protect people from uncertainty, from risk. And as I said at the beginning, it is society's promise to itself. It's rooted in the idea that when something bad happens, someone else will stand behind you. Now, clearly, there's a commercial aspect to that, but it's not a product that people are buying in the same way that they buy many other commercial products. What they're buying is a confidence and a promise. That's why public trust isn't a branding issue. It's not a marketing position. It's not how you advertise insurance. It's the very foundation of the business model. So if public trust is there, the business model works. If public trust isn't, then it won't. If people start to believe that insurers won't pay, that they won't explain what they're doing, or that they'll always find small print to avoid paying out, then the whole idea of shared protection rapidly begins to break down. So when we talk about people risk in insurance, what we're really talking about, to my mind, are the human systems that operate that make or break that promise. And that promise can be made or broken at any one of a number of points within the system. So we know that the management of financial solvency is a really significant aspect of managing an insurance company. And what I'd say is, of course, that is necessary, but there's also this idea of social solvency, whether society believes in what we're doing as an organization enough to let us continue doing the work. And we'll explore that a little bit more when we talk about banking industry and the social gift, some of the social gifts that were removed as a result of the 2008 financial crisis. So public trust, I would therefore describe as a form of capital. It in effect, well, not in effect, it lowers regulatory cost. It's a great way of attracting customers, and it is the social permission to operate that every organization needs. That's why leadership and culture are not in any way side issues in the discussion about the business model and public trust. They are risk controls in the very same way that capital reserves are. So from this, we take the idea that public trust and public value isn't created by marketing and slogans. It's created every single time we as organizations, whether as insurers or anything else, keep our promises under pressure. And if the product of insurance of trust, then I would argue that people are the machinery that make or break it, which takes us on to the human dimension of risk. Darian, next slide, please. So I wanted to just talk a little bit about human behavior and psychology. This is a very high level perspective on it. And there are many places where you can go and explore all of these issues. But I wanted to show you three simple building blocks and show you why they matter for organizational risk. So we'll start with the idea of identity and the question of how people see their role in the system, what they believe they're here to do. This is a fundamental question for every designer of organizations, every designer of people roles, and it's a fundamental output of organizational culture. As I say, it's how people see their role in the system. If I see myself, in the case of insurance, as someone who sells policies, I will inevitably and always behave differently from someone who believes their job is to protect customers. This is why organizations talk about purpose, and the more authentically they talk about purpose and the more directly they connect work to that purpose, the more strongly that identity is aligned with the long-term sustainable outcomes that organizations want. And culture flows very directly from that sense of role. And when identity narrows, so does judgment. And by culture, I mean the behavior of most of the people most of the time. Culture as an outcome rather than as an input measure. Let's just turn on to agency, which is one of thematically for me is one of the things that I am most interested in organizations. Agency is around people having the ability to act, to take direct responsibility for what they do and to be accountable for what they do. It means people having both the confidence and the permission, both formal and informal permission, to act. And it's particularly important that they are able to act when something feels wrong. We can write endless rules, we can write endless codes of conduct, we can talk about it as much as we like, but if people don't believe they are safe to speak up when they see something that they believe is wrong, they will stay silent. So this question of when are people able to say stop or to make a decision without having a formal responsibility for it becomes really, really important. And we know from many, many case studies, many experiences of organizational failures and cultural challenges, that silence is it's certainly one of the strongest predictors of risk events, whether that's issues like mis-selling, misconduct, or safety failures. So creating environments where people feel comfortable to manifest agency, express their views, is a fundamental control in the system. It's not a problem. It's not the problem of people making their own decisions, doing their own things. It should be designed in as a protective control. The third aspect I wanted to frame or to focus on is ethical residue. Ethical residue is the build-up that happens over time when small compromises go unexamined. And I talked about culture as being the behavior of most of the people most of the time. And if most of the people most of the time are making grey decisions, shifting norms, doing workarounds, doing things that once felt uncomfortable and now feel normal, then the culture has already changed. By the time a problem has been identified and become a headline, it's rarely one bad decision. it's usually layers and layers and layers of small tolerated decisions on a journey to so identity tells us who we are. Agency defines whether or not we act, our ability to act, and whether or not we do. And ethical residue shows us what we have collectively tolerated. And between them, these three tell you what most of the people do most of the time, and therefore start to create and define and redefine over time the organizational culture in which people operate. And if that sounds familiar story, if any of that resonates, it should, because there are plenty of real life examples of this. And the banking sector has already lived through this story. Next slide, please. Okay, so let's start with a second poll. Which factor do you believe has the greatest impact on risk outcomes within insurance organizations? So I'm sort of picking up on the themes that I've talked about. Leadership behavior and tone from the top, organizational culture and values, incentive and reward arrangements, customer experience and governance and compliance frameworks. All of these relate to those aspects of identity, agency, and ethical residue. Okay, so we'll give a couple of minutes to vote. If you could do that, that would be fantastic. And then Darren will show us the results. Okay, very interesting. Thank you for that. So half of you think that leadership behavior and tone from the top has the greatest impact on risk outcomes. 20% of you think it's organizational culture and values. 18% think it's governance and compliance frameworks. And then 5% each thinks it's incentive and reward arrangements and customer experience. And of course, you're all right. There is every single one of these can have a very significant impact on risk outcomes, and failure in any of these areas would be an important thing. But we'll talk a little bit more about leadership and behaviour and how that applies. Let's go on to the next slide. Thank you, Darren. Okay, so let's talk about something about what banking led. I don't know. I assume you're familiar with the idea of LIBOR and the kind of the decade-long case study in what happens when there's a gap between performance and purpose. So LIBOR stands for the London Interbank Offer Rate, and the LIBOR scandal started with people manipulating these benchmark London market interest rates to make their desks look better, to achieve the outcomes that their organizations wanted, their banks wanted. And they did that by working together, talking to each other in advance of the formal market setting process, and making decisions that were in the interest of their institutions rather than pure market decisions. People didn't think they were doing something wrong. They certainly didn't think they were committing fraud. They thought they were just cooperating with each other, helping the team, having useful conversations, being connected to the wider market. And that is an example of that ethical residue playing out in real time. So that's the danger of ethical fading, is that culture rapidly normalizes distortions, particularly if they're successful ones. So the outcomes that were achieved from this were ones that the organizations and the banks benefited from and valued. After the scandal became apparent, and it happened not just in London, it happened in quite a number of benchmark rate setting contexts, regulators realized that the rules, and certainly principle-led regulation, simply wasn't enough. And this started in London with the senior manager and certification regime, which applies to all British banks globally and to all banks operating within the UK, which was a requirement that accountability should be both seen and proved. It didn't introduce new principles. It didn't introduce any new ethical codes or code of conduct. All of that existed already. What it did was to ensure that responsibility was absolutely clear, documented, and traceable. And the accountability then could be applied for a fault later in the system, could be directly linked to a specific leader. I mean, it's absolutely as clear as that. This meant that this idea of tone from the top, which is a very popular framing of leadership, stopped being around inspirational speeches and charismatic appearances and became a defined and auditable system. Who owns which decision? Who is accountable for what aspect of business performance? And how do they demonstrate oversight, appropriate oversight on an ongoing basis? Implementing this in the banking sector was a huge amount of work and was not particularly straightforward, partly because the accountability systems within banks were not that clearly defined. It suits many leaders to have these their accountability loose, to have shared responsibility for things that are difficult, and so being asked to apportion responsibility at a top level to senior members of ExCo, for most organizations was a political and organizational challenge. But over time, this began to rebuild confidence. Senior leaders started to understand what it meant in practice. Oversight and reporting systems improved. And accountability became more and more embedded in process rather than people and personality. The result of this has been very clear. There have been fewer scandals in the banking sector, significantly improved governance conversations, a much more mature understanding of culture as part of the control system, better reporting, better management, both at executive level and at board levels. And the opportunity is therefore here. Insurance can and should learn from this, the pain of the banking sector through this period, but without repeating some of the underlying scandals and challenges. So let's have a look at how some of those lessons might translate directly into insurance. Darren, if you move to the next slide. So I wanted to kind of translate some of the conceptual, the cross-industry insights that come from this work directly into insurance. Although it is fair to say that these same conceptual frames will apply into any organizational context. So let's start with, there are three fundamental points that I want to bring. And the starting one is leadership as a control. And if you recall, 50% of you talked about leadership and tone from the top as being the most important factor in risk management. And this argument would support the fact that it's a really fundamental element of an effective risk management system. My position is that leadership isn't a tone-setting exercise. It's a direct and clear control, risk control mechanism. We measure it by how decisions are made, how quickly issues are identified and escalate, and how safe challenge feels, and where challenge is the exercise of agency, and in particular, the exercise of agency to say, there's a problem, there's something I don't agree with, there's something I don't understand, or there's something that might be broken. I would say this is the same as a capital control. It tells you whether the system can absorb pressure without breaking. So it talks to the fundamental resilience of your organizational system. The second I'd like to flag is cross-functional collaboration. So people risk, all of these kinds of human risks and the issues like agency and ethical fading sit in gaps. They sit in the gaps between risk, HR, compliance, and business. When those groups share data, share interpretation, look to understand and are curious about the dynamics that sit underneath the surface, weak signals start to be identified. And most people risk shows up in weak signals. It's small things happening. The LIBOR scandal, the signals were all just behavioral, normalized behavioral stuff. No one was worried about what they were doing. They weren't hiding it, but these were weak signals of failure in the system. Without this cross-functional collaboration, each of these functions, the control aspects of each of these functions manages its own slice, and collectively nobody owns the entire system. I think this requires, in particular, a significant shift in how HR and risk work together. Risk asserting its second line responsibility for people outcomes and people risk outcomes, and therefore working with HR and compliance to look at what data is required to understand that. And HR understanding its first line accountability for managing the processes and systems related to people. Organizations that do this well treat behavioral insight the way that finance treats cash flow. It is monitored, shared, acted on. And we saw some of that in response to LIBOR scandal and as part of the SMCR regime, with a much greater direct and informed oversight of some of these issues. Let's just talk as well about public value, where public value means that how we behave internally shows up externally. And one of the questions that we asked right at the beginning was, how much do you think about internal behavior and culture and values matter? And they got relatively low scores in the polls. But my argument would be that internal fairness, internal transparency, internal ideas about service show up externally. This isn't something that's often thought about in the insurance sector. It's often thought it's much more actually relevant to the most successful hospitality sectors, where the treatment and celebration of, but I'm thinking about luxury hotels and things like that, where the treatment and celebration of the work of people in serving customers, the agency that they actually have, creates a material difference. And the manifestation of the internal culture then becomes the customer experience. So there's a direct alignment between employee experience and customer experience. And this matters because claims fairness, and that was something that people said mattered as a matter of public trust, isn't just customer service. It isn't just that process around engaging with customers. It's also very clearly a reputational control. So the perceived fairness affects the perceived reputational quality of the organization. And as we said at the beginning, if it's a promise, if insurance is a promise from society, and it's felt that that is not delivered on through fair responses to challenges when they arise, then you have a reputational issue. It's also important to recognize, and again, this is something that banking sector spend a lot of time on, particularly in retail banking, that agent incentives are not just about commercial levers. So you're not just growing revenue by incentivizing agents to work in specific ways, and agents, whether external agents or employees. They are conduct risks, and they are conduct risks waiting to materialize if they are misaligned with your values and your desired commercial outcomes. So we see this through many scandals around mis-selling or inappropriate behavior as people chase incentives. And in this instance, incentives doesn't just mean pay systems. It also means recognition and reward systems. So anything that is rewarded through your system has to be directly aligned with the long-term sustainable outcomes that we're trying to achieve. And then the final thing that I'd like to just suggest is a really important area to investigate is to recognize that as AI moves into underwriting and claims, this whole question of data ethics becomes the new frontier, an emerging ethical and system risk that we need to anticipate and start working for rather than chase. Now, you may wonder, why am I talking about AI in the context of human risk? But of course, this sits absolutely intimately with the question of human risk and the role of human beings, real people, in applying judgment, having a role in AI delivery, and being able to act with agency. So the issue tends to become when the AI has independent agency without any assurance or well-defined assurance process. So if we accept all of these things as being a framework for thinking about how these lessons move into the insurance sector, then leadership becomes not just a symbolic process, but really, really structural to risk management, and in effect is the living embodied control that operates within the system. Should we go to the next slide, please? Okay, so let's do our third poll. And the question here is, thinking about all of those things, taking that all into account, what one behavior would most strengthen trust? And I'm asking you to think about this in the context of your organization. So what one behavior in your organization do you think would most strengthen trust? And there are 5 options: fair treatment of customers and ethical conduct, greater transparency and disclosure, integration of ESG and sustainability principles, greater communication, and cross-sector collaboration to address systemic risks. And we'll just give you a few minutes to think about that before Darian shows us the results. Okay, great, thank you. So the fifth half of you think that fair treatment of customers and ethical conduct is the single behavior that would most strengthen trust. Greater transparency and disclosure, 29% of you. Greater communication, 20%. A small number recognize the value of cross-sector collaboration, and nobody has chosen integration of ESG and sustainability principles. I mean, all are actually perfectly legitimate places to start. The question is around diagnosing how your system is working and the most significant issues that play up in your system. You're looking for weak signals, you're looking for areas of strength, you're looking for that as you think dynamically about the system that you're operating within. Where are you seeing challenges and ongoing issues? I mean, I think fair treatment of customers and ethical conduct is a very sensible place to start, understanding, based on the conversation that we've had, some of the entry points for ethical fading, some of the entry points for how culture plays out, and fair treatment of customers as being a really clear outcome of that you can start to track back into your system and understand where that outcome has come from. Transparency and disclosure is generally and always a good thing. This idea of being open is also a really important aspect of permission giving for people to take agency. And that agency includes this space to dissent, space to say something is going wrong. Brilliant, thank you, Darian. Shall we go on to the next slide? So I wanted to sort of just frame with a practical tool, and we'll spend 5 to 10 minutes on this, and then we'll have plenty of time, I think, for conversations as well. This is about what senior leaders can actually do to manage people risk as a system property. That's to say, to think about how people risk plays out through the system and what are the control factors that you can bring in. So, and this again responds to that challenge that I put out there, that leaders should be seen very much as a living, active, embedded risk control through the system. So the first I'd suggest is that we start to measure behavior. with the same diligence as we measure key financial ratios such as solvency, as fundamental as solvency. So boards and executive teams track capital ratios, they track financial data with precision, with interest. They care about them, they ask questions about them. If there is a breach of something, it becomes a major issue really quickly and it's escalated. The same should be true for behavior. Trust data, grievance closure rates, issues, measures of leadership credibility, ethical challenge. These are the kind of measures that should be visible and should be valued. Now, exactly where you start measuring in your organization will depend on how you diagnose the issues. But there should be a routine element around reporting on some of these key aspects of people risk. We know that there is a direct correlation between measures like that and cultural outcome, where culture is the behavior of most of the people most of the time, and where strong cultural frameworks, which encourage agency, which encourage ethical behavior, are fundamental to a sustainable performance. In particular, it's necessary to make challenge safe. Lots of organizations talk about this. I've worked with plenty of organizations that have said, well, we want to create a challenge culture. People should be able to speak freely. They should be able to raise problems. Lots of organizations have invested in speaking up mechanisms. And all of those are good and necessary things. But creating a safe space for people to say that they see a problem, that there's something that they don't understand that they'd like explaining, that we should stop doing something as clearly as that before it becomes a problem. And and the starting point for that is simply asking the question, where can people stop the line? Where is the space for people to speak up? If they do say something, if they do ask a question, what happens? Is it safe for them? Are they heard or are they shouted down? And do they learn from that that they shouldn't raise issues with that when they see them? And not only they learn, but everybody else learns from that as well. If you don't know the answer to this question, you don't have a safety system built in. The third is this question of aligning incentives with ethics. We should reward and pay for long-term trust, given the criticality of trust both to the sector and to organizational performance. This, as I say, is not just financial, although it may well be. At its sharpest end, it's around pay incentive programs, but it's also around recognition and reward in the social sense, and it's around things like promotion. We should be paying for long-term success and trust, not short-term performance and volume. I mean, it's fair to say that nearly every scandal in the financial services sector hides somewhere a pay story or pay and reward story underneath it. Finally, I'd like to just sort of flag this issue around transparency as default. Most of my career, I was a leader of my professional career. I was leading global HR organizations, and as part of that, I had a fair amount of experience of employee litigation and being taken into courts and being a witness in court cases. And that was always my measure of any decision, my subconscious, sort of my rule of thumb about any decision, which is if I was standing in a court of law being cross-examined by someone who was cleverer than me and not my friend, how comfortable would I be explaining what I'd done and why? And it's about this comfort in explaining the decisions we make to regulators or to the public tomorrow. And that doesn't mean you have to be right. It just means you have to have had a reason, a good reason, a reasonable reason, a reason that sits within a set of reasonable outcomes. And if you can do that, if you're comfortable saying, well, it went wrong, but we did this, this, and this, or it went right, and this is why we did it, then you're probably on safe ground. And that was a rule of thumb for me that was really important. Fundamental to this is this idea of leadership as system calibration. And leadership isn't just about code. It's not static in that way. It's not about inspiration. It's not about charisma. It's not about any of those things. They, as a control, I mean, they may be nice to have, but they also in themselves create risks. I would say that leadership, when you think about it as from a risk frame approach, should be seen as an adaptive agentic control. That's to say, it's flexible, it's integrated into the system, and whilst there may be some high-level commonality, there is also a lot of adaptive decision-making dispersed through the system. The job of leaders is to keep the right balance, to calibrate freedom and constraint, so rules and agency, to calibrate confidence and humility. So being clear about your proposition, but also being willing to see an issue, respond to it, to say stop on the way. And when leaders treat culture, that is to say, the behavior of most of the people, most of the time, as part of a control environment, people risk management stops being about HR, housekeeping, and regular reporting and employee relations, and starts to become recognized as something that is absolutely fundamental to enterprise resilience. So I'll close on this by kind of reminding you where we started. We started with the idea that insurance is society's promise to itself, that trust is the industry's true currency, and that risk management is fundamentally a human system, and that people and culture shape every outcome. People risk is the operating system of trust. If you manage that system well, you don't just prevent failure, you actually earn legitimacy. Good, thank you. Next slide, please, Darren. Okay, so people risk is the operating system of trust. Culture turns framework, so ideas about how you want to be, into concrete and manifest behaviors. Leadership calibrates freedom of control and control, managing this balance between the rules, the guardrails, agency, and the ability to spot and respond to issues and focus on public values builds long-term reputational resilience. Next slide, please, Darren. So I think we have some time now to open it up for Q&A and discussion. And I'm going to ask a few questions to you as we start into that. I guess I'd be really interested to know which ideas that I've talked about today resonate most for you and for your organization. I'd be really interested to hear your thoughts about the barriers that stop effective cross-functional collaboration. So the challenge of risk, HR, compliance, how do they actually work together? And I don't mean in a kind of generally aligned way. I mean in a curious collective endeavor to get underneath what's happening and explore the reality of people risk in practice. And how do you think people risk could be better managed in insurance? Thank you. I think there's the next slide, Darian. I think we start to finish off. That just shows, yeah, this is just me. If you go to the next slide, Darian, this is me. That's my email address at the IRM. You can follow me on LinkedIn. My new book, People Risk Management, will be published by Code Page next year. Please do connect, and if you want to get in touch, then you're very welcome to do so. Good, thank you. Should we go to the Q&A section?
Yes, Stephen, thank you for the insightful presentation. I believe at the moment there are no questions in the Q&A box, but perhaps they will start coming in. Perhaps I can start off with one question. My question to you, Stephen, is this. How can insurers realistically balance commercial objectives with the need to build public trust and deliver social value, especially when profitability pressures are high and sometimes the markets may be soft, and we now live in a very uncertain environment? Yeah.
Yes, I mean, it's a really interesting question around how do organizations balance trade-offs over time frames typically. So do we want to take this slide down so we can just see faces, or I mean, you can leave it off if you like. It's just it's a rather too
Yes.
big picture of me to be looking at. Great. And to everybody who's speaking, who's listening on the call, please put some questions in. It'd be really interesting to hear either your responses to the questions that I asked you, or questions that you'd like to explore and talk about. So this is a question of commercial challenges and priorities against long-term public values, and of course public value creation. And of course, this is a question of short-term versus long-term. And I talked about that when we talked about incentives and what's rewarded, and it's just a manifestation of that same issues, where if you reward performance outcomes, particularly short-term performance outcomes at the cost of long-term public trust in this case. And my argument would be a really simple one on this. Commercial performance and public trust reinforce one another over time. They may not reinforce one another over a single business cycle. So if you're absolutely focused on meeting performance targets for this financial year, then you might start to lose a focus on the bigger issues around trust. I would articulate that as an aspect of ethical fading. And for sure, these are all about dynamic equilibrium. So you should see this as a dynamic risk equilibrium where there are certain trade-offs that are made at certain times, but you're looking through the cycle around what happens. I would also argue that public trust should be treated as a form of capital. I talked about social capital. Fairness and accountability are not abstract issues. They are core to the business model, and they reduce control costs, they reduce regulatory costs over time. So that there are real performance and cost issues around that. I think the role of leadership comes into this as well, where the task is to maintain that equilibrium, to make these trade-off decisions at the margin. And we talked about that in the sessions around trade-offs between freedom and control. So setting guardrails, creating spaces for agency, but also balancing opportunity, which is often short-term, with legitimacy, which is always long-term and sustainable. So I would think in that case, it's really important that to recognize that public value becomes measurable through consistency over time, through transparency. And the lesson from banking is that that building confidence is a massive job if you have to rebuild it. So maintaining that confidence, maintaining that trust, and acting now to make sure that the mechanisms are in place to sustain it is much better than having a crisis and then having to respond to it.
Right. Well, there is something in the chat Q&A chat box. Let me read it out. It's from Rebecca Rowan. Hello. Hi, Rebecca. It's good to have you here with us again. She says, I don't have a question, but in response to your question, from my perspective, what I see preventing more cross-collaboration is what's in it for me? Is this going to impact or improve my KPI? How much time will you be taking from my BAU? Those types of attitudes. This is generally therefore due to a lack of top-down communication, in my opinion. Stephen, perhaps your views on this? Thank you,
So I think
Rebecca,
it's
for sharing that. Yeah.
Yes, thank you. I mean, it's a really great observation that there is inertia built into how organizations work, and people are incentivized against KPIs. And KPIs are really interesting. I think they are a risk, an area of risk which is massively underexplored as a risk thing. They're seen as a management tool facilitated through HR. And HR functions usually focus on just the existence of systems, so the operational mechanics of the system, and they may have some operational risk consideration into that. So if our performance management system falls over, what happens? What I see very rarely, and I think is a fundamental gap, is an understanding of how KPIs and targets in their broadest sense relate to each other. And plenty of organizations do try this. There's some sort of cascading of targets, and that's actually not what I mean. I don't mean that can I see the roll up between what you're all doing and what's happening at the top. The biggest issue is exactly the one that you touch on, which is where there's a conflict. So it's a very interesting question around where KPIs or targets sit in conflict with each other. So if I have a target around some, say, let's keep it at a really high level, some trust outcomes, and I have a target around some delivery of specific project outcomes, one is concrete and one is more abstract, then I'm going to focus on the things that I can actually see and control in a much more direct way. The framing question, which I think is ultimately the response. The framing question is what is the real work? I mean, all people in jobs do the activity that they're expected to do. They will do the activity that they're rewarded for, and feeling busy and feeling relevant is important to people. So they'll do stuff that fits in that space. What I'm saying here is that actually there's a need for something different, a need for something which is rooted in curiosity and connection, and that is in fact the real work. The real work of connecting and sharing in different ways. HR people are typically not that comfortable sharing HR data with other functions for all sorts of reasons. Some of them good. I mean, clearly there are GDPR things that need to be thought about, and some of it just about protectionism. And this is my kind of my stash of insight that I'm not going to share. And yet, if we start to think about these as risk data, then we're also starting to articulate the case for why this is an important area to collectively work on and to sort of reshape the work we do, the KPIs that we follow. I'm not saying it's not a journey, but it feels to me like a really important area to focus on.
Okay, we have a comment from Tan Boon King. He said, hence the importance of whistleblowers. What do you think, Stephen?
About importance what, sorry?
Whistleblowers.
Whistleblowers.
Yeah.
Yes. So, I mean, I talked about speaking up, and I talked about spaces for to say stop and to raise concerns. I mean, whistleblowers are a very specific manifestation of that, and whistleblowers are clearly a manifestation of that when things have already gone badly wrong. My articulation of what becomes important is how do you create mechanisms in organizations that create the space where it is expected that people will say the reality they see, ask the questions that they don't know the answers to, as a control for that risk. So by the time you have a whistleblower, you already have a risk event in effect. If you build into your system behaviors and ways of working that are already predicated in speaking up, then you have a manifest control of it. I mean, what's interesting about whistleblowers, of course, is that they are, we see this time and time again, the management of them becomes organizationally very difficult. There are many occasions, there are multiple issues associated with them. People often, by the time they decide to blow a whistle on something, they have become outsiders from the system. So they are, what happens is that the behavioral norms that the system has adopted, they feel excluded from in certain ways. That might be because of a performance issue, there might be some other dispute, and then the whistleblowing often is attached to it, and the organizations focus on not on the whistleblowing, but on the other aspects of it as a way of avoiding engaging with that reality. So yeah, whistleblowers are fundamental. It is entirely right to protect that. The most regulatory regimes do that, and one should respect it and value it, and build those same disciplines of speaking up everywhere through your system.
Okay, and Rebecca has another comment. She says, thank you, Stephen. Yes, case in point, we have a bit of a conflict when it comes to financial targets and sustainability targets. Trying to find this balance is tough. Any tips, please?
Well, this is a time horizon challenge, isn't it? But the risk is that the short term dominates over the long term. Long term should be the focus of organizations. Short term accommodations should be, by definition, short time thinking horizons. And if your executive and your board are focused only on the short term, then you won't have long term sustainability. Something will, So yes. The tip is to make sure that the framing of horizons happens very explicitly, and that decision makers are asked to understand and extrapolate their decisions over both the immediate, the medium term, and a long term performance horizon.
Okay, we have another question from, it's an anonymous one, but it seems that the top man in many organizations or governments sets the agenda and is displaying falsehood and absurdity. How can an employee or customer challenge these lies and statements?
Well, I mean, I hope you're talking the abstract rather than your own direct experience, because that's a very challenging position to be in. I mean, so let me try and sort of unpick a couple of sort of general things that sit within that. And the first is, I mean, my framing of leadership is not about the cult of the individual. It's around leadership as systemic agentic control dispersed through the organization, and balancing dilemmas such as freedom and control, dilemmas such as time horizons, and balancing opportunity with legitimacy. If that is dominated by one or a small number of people, then that can rapidly move into imbalance. And we talked about behavioral culture, and recognize that culture is not just a generic that sits across organizations. You'll get many pockets of different cultures which are dominated by individuals. So you can have assertive, toxic, self-confident leaders at any part of an organization can create bubbles around them that are potentially highly risky. As an individual sitting within those systems, you don't necessarily have many choices. I mean, you should always be focusing on your own action and being the same principles that I talked about how would I articulate accountabilities in a public forum should apply in all of those circumstances. My personal experience of working for leaders who I thought were toxic is that you leave.
Very good point. Yeah. I'm going to move on to one last question, just to change the topic a little bit as we move towards 4 p.m. now. What practical methods or indicators can organizations use to assess and strengthen their risk culture over time, Stephen?
So I think I mean, the culture is often talked about in a really abstract way, and we only have this is a massive topic, Barry. So,
Yeah.
but we have a couple of minutes, so I'm going to keep it really, really, really
We can
quick.
give you a few more minutes, no problem.
No, the issue is around how do people think about and measure culture, I think. And I've articulated culture not as an abstract, but as a behavior of most of the people most of the time, recognizing that that is not monolithic across organizations. So most of the people, most of the time in one place, one business unit, one team, one country within a multinational organization may operate with quite distinctly different cultural aspects of it. So I think what one starts to need to do is to break that down into a number of factors that you think are really, really important as indicators of risk. And I talked about some of those when we talked about leadership. So examples of those would be dissent levels. And we've talked about this throughout the, but then the question comes, this. So I've said it's not, we talked about whistleblowing, and I said, well, actually, what we should be doing is creating spaces for people to dissent. But that also means creating mechanisms for dissent. And we're not passive observers of these processes. We run these organizations. We design how meetings work. We tell people what their jobs are. We say what your KPIs are. And if one of your KPIs are, you should 10 times a year, you should be raising an issue with your manager where say, I've observed this and I'm worried about it. And actually that's a KPI, then that's a good, sensible thing to do. You might have processes where in teams, in meetings, for example, team meetings, there are expectations that people take on a role of devil's advocate or challenger, and they are expected to, when there's a big decision, I mean, clearly you don't do about everything, but when there's a big decision or where there's a high risk decision, somebody comes into it with the challenge responsibility, say, well, that's great, but here are 3 things that I think we need to answer collectively before we can be comfortable with this. You think about how you structure who speaks when in meetings. So instead of starting with the leader speaking first and therefore shaping what everybody else is going to say, you start with maybe the most junior person speaks first. And you listen really carefully to what they have to say because they're bringing a perspective that probably wasn't there in some of the other discussions. And then the leader summarizes what they've heard and talks about what they're going to do with that insight rather than starting by shaping the whole conversation. So there are real things that you can do straight away that are not difficult, that are not expensive to start to shape how this work. Decision speed is a fantastic indicator of whether the system is working. So
Yeah.
understanding aspects of decision latency and exploring what underpins that starts to tell you a huge amount about how leaders see their jobs. And then practical employee relation things like grievance closure rates, how long it takes, what happens, are genuine indicators of systemic risk.
All right. Thank you so much. We have come exactly 1 hour. Thank you, Stephen, for your wonderful insights on this topic. My thanks to IRM, Institute of Risk Management UK, for the collaboration. Thank you for all of you for attending this session. We shall now bring the session to a close, but please do fill in the evaluation form that will pop up on your screen before you leave. Once again, on behalf of the Singapore College of Insurance, thank you so much. Have a good weekend. Bye-bye.
Bye bye.
Bye-bye.